I am rolling now. I can't believe how quickly I get through the. You may not think these are quick, but I'm definitely getting through these very fast because I'm leaving out all sorts of stories. They're awesome stories, but I'm really trying to be as efficient as possible for you. If you guys do like the stories, you gotta let me know, and I'll fold the stories in as we move forward. Um, and who knows how far along I'll be in the videos in terms of recording them, but man, I want to roll, and I'm really, really trying to not speak with my hands flying around. I'm making a conscious effort to try not to do that as well. I'm going to be a pro at this by the end of the semester. Okay, so this video we're going to talk about the sale of our inventory. We're now dealing with transactions between the merchandiser and the consumer, you and I. Okay. The very first thing that we do want to talk about, maybe we haven't emphasized it at all in any of these previous videos, is that we're working with an inventory system that we call a perpetual inventory system. And a perpetual inventory system is one that a great example is kind of like a supermarket where we go to, hold on one second, phone's ringing. We go to the supermarket, and as the cashier is sort of like scanning the can of beans across the register, two things are happening simultaneously. The first thing is we're getting charged for the can of beans, and that's going to get added to our total bill when we check out. But the second thing that's happening simultaneously is the cash register is sending information to the storeroom or the inventory clerk, letting the clerk know, hey, we just sold a can of beans, and so we need to reduce the inventory associated with the can of beans. And then we need to think about when we will be reordering more beans. It's all happening perpetually. There's an alternative inventory costing system called the periodic, and that's more for a like either a small place of business or something that doesn't have a lot of transactions simultaneously or at all at once. You can afford to use, you can update your accounting records periodically. Okay, so in a perpetual system, the first thing that we want to keep in mind is that when we make a sale, we have to record, sorry, we have to record two things. We have to recognize the revenue that we're generating, but then we also have to record the expense associated with the inventory we're selling. So, in our example where we're buying toilet paper, if I assume that I'm selling 20 rolls of toilet paper, and I'm selling each roll for $2, and maybe I can sell on account, right? It's not unreasonable for commercial consumers to purchase large volumes of toilet paper on account. The journal entry to record the revenue side of the sale of toilet paper would be accounts receivable. And if I am selling 20 rolls and each roll I'm selling for $2 a roll, then the accounts receivable would be $40. And then I don't know what that was. The credit is going to be sales revenue. That's the first journal entry associated with the sale of inventory. And then, like I said, every time we make a sale under the perpetual inventory system, we have to do two journal entries. The second one now is going to record the cost of goods sold. All right, so if I sold 20 rolls of toilet paper and each roll cost me $1.20, then my cost of goods sold, that is an sorry, yes, it's an expense. And therefore, if I want to record an expense, I would debit it because that's lowering my income or my equity. And so the cost of goods sold, it's 20 rolls of toilet paper times $1.20 per roll. I get $24. And then not only am I recognizing the expense, but I'm also lowering my merch inventory account, like we talked about. And so I'm going to have my income statement is going to be revenue, $40, cost of goods sold, 24, and then my gross profit of 16. I will also have a T account, right? Inventory. And assuming I purchased $100,000 worth of toilet paper and I just sold 20 rolls that cost me $1.20 a piece, I would then credit, like we said, merchandise inventory by $24, right? This is the balance sheet, and then this is the income statement. All right, discounts. Just like my vendors provide me with discounts to incentivize me to pay them sooner rather than later, I'm going to do the same thing with my customers, right? So if I'm selling toilet paper on account, I'm going to provide incentive for my customers to pay me in advance. The sooner that customers pay me in advance, the more likely it is I get paid. The longer it takes for a customer to pay, the more likely it's the case that they may not pay. All right, so in this analysis, I'm going to ignore the cost of goods sold and the inventory account because sales discounts will not affect those. And I want to just sort of focus on the revenue side. So at the time of sale, I'm selling 20 rolls of toilet paper for $2 a piece, and I'm telling my customer, hey, listen, I'll sell it to you on account, but I'll give you a 5% discount if you pay me within 7 days. Remember, that's the discount, and that's the number of days that you have. Otherwise, you will pay me the full amount, whatever that is, that's why it's N, within 60 days. So the journal entry to record revenue would be accounts receivable. It looks just like it did previously, $40. And then revenue, $40. Now, if the customer chooses to take advantage of this discount, right? So if within a few days the customer decides to pay, then the cash that we receive isn't going to be $40. It's going to be $40 less the 5% discount. So let's see what this looks like. I am going to credit, actually, I apologize. I am going to debit cash, and it's not going to be $40. The cash that I'm going to receive is 95% of $40, otherwise known as $38. Now, the customer owed me 40, and now that they're squaring up, they no longer owe me accounts receivable. So I will credit accounts receivable. I'm just going to provide myself a little bit more room. Accounts receivable, 40, and therefore the missing debit is now what we call discount, or in fact, we can call it sales discount. And a sales discount, that's going to lower my revenue. And if I want to lower revenue, I would do it with a debit. If the customer chose to pay after the 7-day period, then it would just be The alternative journal entry would be cash 40, accounts receivable 40, because they didn't take advantage of the discount. So they get no discount. I am going to try to do sales returns and allowances. I'm going to try to do that with the PowerPoint slides. And boy, you're going to hurt my feelings if somebody sends me an email saying, wow, use the PowerPoint slides more because your writing is so bad. Anyway, in this instance, we're going to deal with a situation where a customer is going to want to return goods and services for a refund. Um, and so in this particular situation, we've already made the sale. So we recorded the accounts receivable or cash and revenue. And then we also recognize the cost of goods sold and lowered our inventory. So now the customer is coming back and they want to give us back whatever product it is that they are purchasing. Maybe it's a toaster, who knows? But in this particular example, we're saying, listen, if it is a toaster, we sold them the toaster for $15 and we paid $9 for the toaster. Okay. And so we're essentially at the time of sale. In fact, I could even write it right here. I would have, in fact, we're assuming cash. So I debited cash of 15 and then credited revenue of 15. And then I recognized cost of goods sold 9 and then inventory 9. Okay. So if the customer returns, I'm essentially going to unwind both of these transactions. So instead of reducing revenue, we are going to create a contra revenue account called sales returns and allowances. And we're going to debit that by 15. And so if I just think about the way that my income statement looks like, I could have gross revenue of 100,000. Then I can have sales discounts of 2,000. And then I can have returns, total returns of 1,000. My net sales would be 97,000, right? So sales returns is going to lower my revenue. And so I'm going to give the customer back their cash. And so I'm going to credit cash. This first transaction is to unwind revenue. And then down here, the assumption is, hey, you know what? The toaster still works totally fine. The customer, for whatever reason, didn't like the way that it looked in their kitchen, so they wanted to return it. So what we're going to do is we're going to take the toaster and we're going to put it back on our shelf. So we would increase our inventory and then we would unwind the cost of goods sold expense that we previously recognized up here at the time of sale. Okay, it could be the case that a customer wants to keep the toaster and instead just wants a discount on the price of the toaster. So they're like, hey, we paid $15 for it and I want to just like, I want some cash back because I'm not happy with the way it looks in my kitchen. So that would be an allowance, not a return. And an allowance is going to be another contra revenue. And then we would give the customer back some cash. There wouldn't be any inventory to unwind because the customer's keeping their good. Or it could be the case that the toaster didn't even work. And so we're just giving this customer back some money. And now, boy, now I have gross revenue minus sales discounts minus returns and allowances. And sales, returns, and allowances is going to be the combination of all the returns and all of the allowances. Freight, right? So there will be instances when we do sell toasters or toilet paper where we, the seller, are going to be responsible for paying the shipping cost. Now, when we do, or if we do have to pay for the shipping cost, that is a miscellaneous expense. And so it would be way down on the income statement, right? So I would have net revenue, then I would have my cost of goods sold, which would give me my gross profit. Then I subtract out all of my operating expenses, we were saying. The shipping expense associated with the sale of goods and services gets included in operating expenses. It's not something that's likely to come up. Remember, when we purchase inventory, we treat the cost of the acquisition of the inventory as a cost of inventory, but not as a cost of sales when we sell.